Hello everyone. So in this lesson, we shall be looking at the sell entry rules for our swing trading system. So let's get started. So basically, in the last lesson, we did look at the buy entry rules, and with the sell entry rules, basically we are looking at the opposite of what we did in the buy entry rules. Okay. So the first thing that you're supposed to identify is you're supposed to identify the place where the trend changed. Okay, so in this case the trend changed there when the white line went below the zero line. So you've identified that part, and then the next thing that you're supposed to do is you identify the previous histogram high before the trend changed. Okay, so in this case the previous histogram high was somewhere there. So it was this one whereby you did have these histograms above the zero line. Okay, and then the next thing that you're supposed to do is you have to identify the highest point within this period. Okay, this whole period when you did have this histogram high. Okay, it doesn't matter if it is dipped below the zero line in that instance. Okay, but what matters is that around that zone, okay, you have the highest point, and you did have the highest point right there. Okay, meaning that we shall start plotting our Fibonacci retracement tool from this point downwards. Okay, and then the next thing that you're supposed to do is we wait. Okay, we wait that during this impulse move to the downside, this one, okay, we wait until it finishes. Okay, and then we have a retracement that would have started. So it did get confirmation that retracement is started at that point right there. Okay, so at this point right there, that is when you take your Fibonacci retracement tool and you draw it, okay, all the way to the lowest point of that impulse move. Okay, so you'll draw it from the highest point to the lowest point of that impulse move. Okay, and then right after that you draw your sweet zone. Okay, it has to be within the 50% to 61.8% level. So right after drawing your sweet zone, and then you also draw your invalidation level, which is right there. Okay, and then you delete your Fibonacci. Now let's take a look at this. Price would not have yet reached your sweet zone at that point. Okay, you still be waiting for price to enter that zone. Now when price enters this zone, you are now waiting for the trigger. Okay, the trigger is basically your oscillator changing from a green color to a yellow color. Okay, and then you are entering your trade right there at the change. Okay, so you're entering at the close of this candlestick right there. Okay, and then your stop loss should be above the last swing high. In this case it will be somewhere there. Okay, so your entry would have been there, and then your stop loss somewhere there, and then you target a 1:3 risk to reward. In this case I think we wouldn't have gotten it, so it's 1, okay, and then 2, and then 3 would have been below there. Okay, the main reason for that is that our stop loss was a little bit too far. Okay, so our take profit basically would have been somewhere there. So in this case it really doesn't matter, because what you'll be waiting for is that if the histograms change to a green color, okay, before your target is hit, okay, or if your histograms do change to a green color right after your target is being reached, okay, then you close your trade at a profit, okay. So in this case, you'd have closed your trade somewhere there at a profit, okay. Let's take a look at another example. So here again, we have to identify the trend change. So the trend change occurred right there when your MACD occurred, when your MACD white line went below the 0 line, okay. And then after your MACD line went below the 0 line, you look at where was the highest point before all this happened, okay. So in this case, we have got this up move there, okay, this up move right there, okay. That is where you have to draw your Fibonacci retracement tool from. So basically this tells you that during this last or the last histogram high, okay, we did have the highest point, okay. So this is the zone where we shall look for our highest point, and our highest point is that one, okay. So we draw for our Fibonacci retracement tool using this highest point, okay. And then the next thing that you have to do is to wait until a retracement is shown to have started. So the retracement would have started right there, okay, when you hit your MACD going above the 0 line, okay. The histogram, MACD histogram going above the 0 line. And then right after that, as soon as that histogram is formed, you draw your Fibonacci from the highest point all the way to the lowest point of that impulse move, okay. And then that would have been somewhere there, okay. But then the problem is during this period, we did have an extension to the downside there, but then your histogram did not go below the 0 line, okay. So what do? You extend it to the lowest point right there, okay. And then we had price shooting up, and then after shooting up, what you'd have done is you'd have had your switch zone drawn already, okay, and then your Fibonacci would have been deleted, okay. Then after your switch zone has been drawn, okay, you are now waiting for an entry point. So you get your entry point when the histogram changes from a green color to a yellow color after rejection within that switch zone, okay. And then right after that, your stop loss should be somewhere there, okay, above the last previous high. And then your market entry would have been right there, and then you are looking for a 1:3 risk to reward, which is 1, and then 1, and then 2, and then 3. So they've been looking to exit your market somewhere there, okay. And then if we take a look at this, our exit would have been somewhere there, okay, way before the market actually reached this 1:3 risk to reward level, making sure that your risk to reward is around 1:2.5, okay. So you could have exited before your target when you had these histograms changing from a golden color to a green color, okay. So in this case, you'd have been risking about 54 pips. Remember, I said that the risk should not exceed 75 pips, okay. If it's 75 pips and higher, then you should not take the trade, okay. And then you'll have been getting 148 pips as your reward. Okay, so basically that's it on this example. Then we've got another one. We do have this impulse move. Okay, this is a downtrend that has already started. Okay, so this time we won't have to identify the place where the downtrend started first. This time you just have to identify the last tracement that happened. Okay, so the last retracement would have been this one, and at this phase basically you would have been looking at the impulse move, which is that one. Okay, and then you can see that the last retracement was this one, so you start drawing your Fibonacci from that level. Okay, the highest point within this retracement. Okay, and then you draw it to the last low, and then the last low basically we say that you get it when your MACD histograms go above the zero line. Okay, when they go above the zero line, then that's when you draw your Fibonacci retracement 2. Okay, and then this is something very important. We say that our Fibonacci basically shall be using it to identify our sweet zone. Okay, so our sweet zone is this one. And then we also did say that as soon as your candlesticks show that they are not actually going above this invalidation zone, okay, which is written invalid trade, as long as your price does not go above that level, then the trade is still valid. Okay, so this is something very important to note, okay, for both the buy entry and the sell entry. So you'd have been looking to make your entry right there. Okay, let's delete this fib. So you'd have been looking to make your entry right there, and then you'd have been looking to exit your market above the last swing high, okay, at a loss, and then at a profit you'd have been looking for a 1:3 risk to reward. So it would have been 1, and then 2, and then 3. Okay, so your exit should have been somewhere there. Okay, and it would have been reached right at that point over there. Okay, and then we do have another one. Okay, another example. We do have a downtrend. So this time we won't have to identify the place where the trend changed. Okay, the first thing that you have to do is, as soon as a new impulse move starts, which is this one, okay, what you have to look at is this zone. Okay, this will be your important zone, the zone where you start drawing your Fibonacci from, because it is the one that actually gave you this retracement high on your MACD oscillator, this one. Okay, so the next thing that you have to do is to wait until this impulse move finishes. That's if you didn't have an opportunity during that period. Okay, and then the impulse move did finish right there. Okay, and right after finishing, the next thing that you have to do is you draw your Fibonacci all the way to the low there. Okay, and then you wait. Okay, and then price did show a rejection right there. Okay, you deviate your zone somewhere there. Okay, you deviate your zone somewhere there, and then let's delete this one. So in having this zone, you'd have made your entry somewhere there. Okay, hoping for a 1:3 risk to reward, and then your entry would have been right there. Okay, and then your stop loss above there. Okay, and then you'd have lost this trade. Okay, because your stop loss would have been hit right there. Okay, but If price comes back to the same zone, okay, and gives you another rejection like it did there, okay, and then the next thing that you're supposed to do is you don't take the trade, okay, because it is showing you that the market is consolidating, okay. You do not repeat the same zone twice, okay, especially after your stop loss has been hit, because it might be telling you that the market is actually consolidating during this period, okay. Then let's take a look at this one. This is another example, okay. If we take a look there, we do have an impulse move right here to the downside, okay. If we take a look at our MACD closely, you can see that we do have an impulse move to the downside right there, okay, meaning that the previous area was a high, okay. So this means that we have to draw our Fibonacci from that point down to that low over there, okay. And then we'll notice that the impulse move ended right there, okay. And then this was showing you that the retracement is started, okay. And now during this period, all you would have been waiting for is a yellow histogram, and you did get it right there, okay. So again, you target your 1:3, and then the trade would have been a success, okay. Then let's take a look at this one. So again, this one is the one which occurs when there is a trend change. As you can see right there, that is when your white line went below the zero line, okay. So if we do this, you'll notice that we do have a high right there, okay. This one, this was the last swing high, okay, as shown by your MACD histograms. And then you notice that we would have been waiting for this impulse move to the downside to end and the retracement to start, and it started right there, okay. It was shown to have started right there, and then immediately after that, what you are supposed to do is to draw a Fibonacci retracement tool from the highest point to the lowest point, which is down there, okay. And then we draw our rejection zone, and then you can draw your invalidation zone, okay. And then just to avoid any clumsiness on your chart, you delete the Fibonacci, okay, and then you are left with that zone. Then we'll have to wait until the histogram changes from a green color to a yellow color, and it did right there. And when it did right there, you're entering your trade, then your stop loss should be above the last swing high, which is somewhere there, okay. And then your take profit should be a 1:3 risk to reward. So that's 1, that's 2, and then that is 3. So your target would have been reached most likely right there, okay. But if we take a look at this, you'll notice that we did have something bothering us right there, okay. Our MACD histogram did change from a yellow color to a green color, okay, prematurely after a 1:2, maybe 1.5 risk to reward, okay. So here you'd have had a tough choice to make, okay, a tough choice whether to actually exit the market at a profit. What you could have done is you take your stop loss, okay, and then you move it into a profitable zone, okay, to maybe cap your 1:1 risk to reward, okay, to make sure that no matter what happens, you are gaining at least what you had initially risked, okay. The market would have eventually made a U-turn in your direction, but then no one knows that, okay. So you could have easily closed your trade right there, okay, but you would have closed it at a profit, okay. Okay, so let's take a look at the pound dollar. Okay, so thank you very much for attending this lesson. See you on the next one. Bye bye.